China locked down silver. The world panicked. Then Beijing dumped more metal than ever before, and silver still exploded higher. This wasn't a mistake. It was a warning. On January 1st, 2025, China quietly rewired the global silver market with a single policy announcement. Without fanfare or explanation, Beijing placed silver under state-controlled export licensing. Every ounce leaving the country would now require government approval. To most observers, the meaning seemed obvious. China was tightening supply. The world's largest manufacturing engine was choosing to prioritize its own industrial needs. Analysts warned of shortages. Industrial users scrambled to secure inventory. And silver prices responded immediately, climbing as the market digested what appeared to be a decisive strategic move. At the time, the logic made perfect sense. China dominates global solar panel production, responsible for more than 80% of total output. Each solar panel requires silver paste for electrical conductivity. As China accelerated its renewable energy rollout in 2025, installing record amounts of solar capacity, demand for silver surged. Combine that with growth in electric vehicles, electronics manufacturing, and military applications, and the conclusion seemed unavoidable. China would hoard silver aggressively. Export restrictions were interpreted as a calculated power move, similar to Beijing's historic playbook with rare earth elements. For months, the narrative held. Markets adjusted, prices rose. The assumption was that China had secured its silver position and would now dictate terms to the rest of the world. Then October arrived and shattered that assumption completely. In October 2025, China exported approximately 660 metric tons of silver in a single month, the largest monthly export ever recorded. Even more shocking than the volume was the destination. The metal flowed directly into London, the heart of the global bullion market. This was the same market Beijing was supposedly cutting off. This wasn't a gradual easing of controls or a subtle policy shift. It was a sudden, massive release, a flood, and yet the market didn't react the way it was supposed to. Silver prices did not collapse. They didn't stall. They didn't even hesitate. Instead, they continued climbing, eventually reaching historic highs by December. The emergency dump failed, completely. That failure forces a critical question that most mainstream analysis refuses to confront. Why would China reverse course so violently after just 9 months? And why didn't the largest silver export in history accomplish its intended goal? To answer that, we have to revisit the original January decision with fresh eyes. The export restrictions were never about building reserves or weaponizing supply. They were about managing scarcity. China wasn't locking down silver because it had plenty. It was doing so because it didn't. The real story was unfolding quietly inside China's own inventory data. Holdings on the Shanghai Futures Exchange, one of the few transparent measures of Chinese silver stockpiles, had been collapsing for years. From early 2021 through 2025, visible inventories fell relentlessly. What once stood at more than 3,000 tons shrank to under 800 tons by late 2025. That is not a drawdown, that is depletion. This means China wasn't stockpiling silver, it was burning through it. So when the London market began experiencing a physical squeeze in the second half of 2025, Beijing found itself cornered. London is not just another trading hub. It is the backbone of global price discovery for silver. When physical metal becomes scarce there, the entire pricing mechanism starts to fracture. Buyers were paying steep premiums just to secure delivery. Fabricators faced delays. Settlement risk increased. Confidence began to erode. At that point, China had a choice, none of them good. Allow London to seize up and risk a global breakdown in silver pricing, which would ripple through manufacturing supply chains worldwide, or release silver into the market to keep the system functioning, even if it meant draining already thin reserves. China chose damage control. The October export was not strategic dominance. It was emergency intervention. Beijing became the supplier of last resort, not to suppress prices, but to prevent systemic failure. The goal was to buy time. And yet, even after injecting hundreds of tons of metal into the system, the imbalance remained. Prices kept rising because the problem was not temporary. It was structural. Industrial demand for silver has crossed a threshold where mine supply can no longer keep up. Solar manufacturing continues expanding globally. Electric vehicles require increasing amounts of silver for power management systems. Data centers driven by AI infrastructure consume silver in dense electrical components. None of this demand is optional. None of it can be deferred easily. And none of it can function without silver. That is why the October dump failed. It exposed a truth the market had been slowly approaching for years. Global silver supply is insufficient for modern industrial civilization at current prices. China's own numbers confirm this. Annual silver production inside China sits around 3,300 tons. Annual consumption exceeds 19,000 tons. The gap, over 15,000 tons every year, must be filled by imports or inventory drawdowns. For years, stockpiles absorbed that difference. Now those buffers are nearly gone. Shanghai inventory data makes this undeniable. By December 2025, visible stocks represented less than 2 weeks of domestic consumption. Even if China holds additional off-exchange reserves, the direction is clear. Depletion is accelerating, not stabilizing. And once inventories approach critical levels, policy behavior changes fast. This is where the story widens beyond China. While Beijing was exporting silver to stabilize London, another force entered the market aggressively: India. During September and October 2025 alone, India imported more than 2,600 tons of silver. That scale stunned commodity analysts. Much of that metal passed through London and Hong Kong, revealing a complex web of rerouting as global supply strained to meet demand. India's appetite is not speculative. The country is undergoing rapid industrial expansion, installing record solar capacity while maintaining one of the strongest cultural preferences for physical silver ownership in the world. Industrial demand and investment demand reinforce each other. When India buys silver, it disappears from circulation. The result was visible everywhere. Shanghai prices maintained double-digit premiums over Western benchmarks. Indian futures traded at elevated levels. Physical delivery delays stretched from days into weeks. This wasn't paper volatility. It was real-world scarcity. History offers a warning here, and it comes from China's own playbook. In the early 2010s, Beijing restricted rare earth exports. Prices exploded, supply chains fractured. The world scrambled to develop alternatives. But there is a crucial difference this time. Silver is not easily replaceable. No metal matches silver's electrical conductivity. No metal matches its thermal efficiency. In solar applications, substitutes reduce performance dramatically. In high-frequency electronics, alternatives fail under load. In medical uses, silver's antimicrobial properties cannot be replicated without risk. Physics sets these limits, and physics does not negotiate. That is why price continues to rise despite intervention. Now add geopolitics to the equation. In 2025, the United States classified silver as a critical mineral. That designation opens the door to tariffs, export controls, and national security-based trade restrictions. In an environment of escalating trade tension, silver becomes leverage. Even the threat of restriction alters behavior. Buyers rush to secure supply. Producers hesitate to sell. Prices move ahead of policy. Zoom out further and the picture darkens. Global mine production has stagnated. New discoveries are rare. Development timelines stretch a decade or more. Meanwhile, industrial demand continues rising year after year. The silver market has run structural deficits for multiple consecutive years, draining above-ground inventories worldwide. This is not how markets correct gently. This is how they break. Every month the deficit persists, available supply shrinks further. Every emergency release pulls future inventory into the present. China's October export bought time, but time is running out. What comes next is not a mystery. If China tightens exports again, global supply contracts and prices surge. If China bids aggressively for imports, prices surge anyway. Either path leads higher. The only mechanism capable of restoring balance is demand destruction, and that requires prices high enough to force conservation, substitution, or outright shutdowns. Historical ratios reinforce the danger. Silver remains historically undervalued relative to gold. In periods of crisis, that gap closes violently. And unlike past silver rallies driven by speculation, this one is anchored in physical necessity. Markets are no longer debating whether silver is scarce. They are discovering how scarce. Watch the signals: inventory levels, physical premiums, delivery times, export approvals. When these indicators align, paper pricing loses relevance. Cash settlement replaces physical delivery. Confidence evaporates, and price does not climb, it gaps. China's October export was supposed to restore calm. Instead, it revealed the system's fragility. You cannot dump your way out of a structural deficit. You cannot legislate new metal into existence. And you cannot override physics with policy. Silver is being consumed faster than it can be replaced. Stockpiles are thinning. Demand is accelerating. The margin for error is gone. The question is no longer whether silver breaks higher. The question is how violent the repricing becomes when the last buffer finally disappears. Because when that moment arrives, the market will not wait for consensus. It will reprice instantly.